Why do so many people start options trading and then suddenly quit? Well, it's because they focus on the wrong information and set themselves up for failure. It's really not even their fault though, because there's just so much information out there and it's hard to sift through and know what's actually important. So in this video, I'm going to show you the 5 things that I think are most important to focus on and understand as a newer options trader. And these 5 key concepts, these are the ones that I have taught to many students like Marlene, who was struggling for months trying to figure out options trading on her own without much success. After going through my Options Academy course, Marlene went from confused about how options work to confident making her own trades. Plus, she has a resource she can use whenever she feels stuck in the future. There's a link in the description if you'd like to have the exact same success. So why is what I'm about to show you so incredibly important? Imagine how long it would take you to go on a road trip without any kind of GPS and not knowing your route. It would be really frustrating, right? You'd be stopping for directions all the time and start to question if the trip was actually worth it. But when you have a map and know the route, the trip is a piece of cake. You get to the end goal way faster and you're more relaxed along the way because you know you're on the right path. So knowing these 5 things is kind of like your GPS for starting options trading. And the first step is proper risk management. Most videos for beginner traders focus on what options are and how they work. And yes, that's important, but I believe that if you don't understand the risks up front, you shouldn't go any further. Yes, options trading is riskier than most other investments out there, but the risk can be managed and reduced by understanding this. If you put $10,000 into your trading account to trade options, please know that if you mess up, do the wrong thing, or get too greedy and start gambling, it could all disappear. So only trade what you're willing to lose. Obviously, I don't want that result for you. You don't want that result either, but you should be able to accept losing your entire account as a beginner. This will stop you from trading with too much money and putting yourself in an uncomfortable position, like borrowing money from a line of credit, losing it all, and still having to pay it back. Now, to manage your risk, to make sure you don't end up losing it all, when you make an options trade, a good rule is to never put more than 3% of your entire account on the line. So if we use $10,000 as an example, the maximum loss you should have in your trade is $300 or less. Instead, you get multiple shots at making winning trades. And what I found is if you can win 80% of the time and accept losing 20% of the time, you can make solid returns. Now that you know how to manage your risk, let's talk about the different types of option contracts. There's only 2 types, call options and put options. And there are 2 important things you understand with how they work. Number 1, if you buy options, whether it's a call option or a put option, you are paying money to gain control. When you buy a call option, it's kind of like putting a deposit down on a video game that's being released next week. You pay $100 today to lock in your price at $200 for the game, and if the store ends up raising the prices to $500 later on, you still get it at the price you locked it in at. You paid and bought the control. When you buy a put option, again, you are buying control. It's kind of like buying insurance for your phone. Maybe it only cost you $200 to buy the insurance, and then if you break your phone anytime within the next 30 days, you can still sell it for its original value back to the phone company. You buy the right to be protected. Here's an example of when it comes to stocks now. Let's say you buy a call option on Apple stock for $100. You just paid for control and the ability to buy 100 shares of Apple at $200 per share. If Apple stock goes up to $300, you can still buy it for $200. Now, if you were to buy a put option on Apple stock, let's say for $100, you just paid for the ability to sell 100 shares of Apple at $175 per share. If Apple stock price goes down to $150, you can still sell it for $175, which is a much better deal. That's how the buying side of stock options work. But as you can probably guess, with every buyer comes a seller. And that is the second thing to understand with calls and puts. When you sell them, you are getting paid to take on risk. When you sell a call option, you get paid, which is great, and you take on the risk of having to sell shares at a certain price. Imagine you had a Michael Jordan rookie card and one of your friends wanted to take it home for a few weeks. Because it's valuable, you charge them $200 to do so. You also agree that if they wanted, they could buy the card from you at any time for $5,000. Not a bad deal for you, right? The only risk here is if somehow the value of the rookie card goes up, and let's say now it's worth $10,000 because your buddy gets an appraiser to take a look at it. Well, you agreed to sell it for 5,000, so you missed out on some of the profit there, but still not the end of the world. Now, when you sell a put option, it's as if you saw a house on your street that you really liked and wanted to buy. You go over, you knock on the door, and you tell the homeowner, hey, I love your house. I'd be willing to buy it for $300,000 anytime in the next month. Maybe the house is currently worth $350,000 though. So the current owner says, I'm not going to get rid of it right now, but I'll pay you $500 to keep that option open for 30 days. You sell the contract to the homeowner, they're buying it. You get paid 500 bucks. And if the housing market stays the same after 30 days, the contract would expire and you'd keep the 500. You could then offer the same deal to the owner and try to get paid again, or maybe the housing market drops and the value of the house goes from 350,000 down to 275. Then your neighbor would say, hey, I want to take you up on that contract, and you'd be on the hook to buy the house for $300,000. Not a bad deal for you though. You get paid 500 bucks and get a $50,000 discount on the price of the house from where it was a month ago. If we flip this into a stock example, shares of Microsoft are currently at about $450 per share. Let's say you can sell a call option at $500 and get paid 200 bucks to sell the contract. So if Microsoft's stock price rises up to $600 a share, you'd have to sell your 100 shares for that $500 per share value. But if Microsoft's stock price doesn't go anywhere or stays the same, you get paid that 200 bucks and the contract would expire worthless at the end of, let's say, 30 days. If you were to sell a put option contract on Microsoft, again, the stock's around 450, let's say you chose the $400 strike price for your contract price. You might get paid $300 in premium, but you'd be on the hook to buy 100 shares of Microsoft at $400, even if the price went from 450 all the way down to 250. Your best case scenario, however, is if the price of Microsoft stays the same or moves higher, then the contract would expire after 30 or 60 days, whatever the expiration date was. We'll get to that in a minute. And you get to keep your 300 bucks, pocket the cash, turn around and do it all over again. And those four types of contracts, buying a call, buying a put, selling a call, selling a put, make up the foundation of all options trades. Now you may be thinking, that's great, but how do I know when to buy versus sell or use a call versus a put? Great question, and one that I'm going to explain here, but I've also taught many students at a deeper level in a quicker pace inside my Options Academy course, linked in the description of this video. So the third key thing for you to understand is option trading strategies. The terms bullish and bearish come up a lot in options trading. A bullish market is when a stock price is moving up to the right on a chart or going from $100 to $150. Bearish is the opposite, is when a stock is moving down to the right on a chart or going from $100 down to 50 bucks. An easy way to remember the difference is thinking of a bull flicking its heads and its horns up and a bear swiping its paws down. Now, as an options trader, you will have a bullish, bearish, or neutral outlook when you make a trade. Meaning, you think the stock you're trading on will go up, go down, or stay the same. Once you know that, and I'll show you some tips for making that decision coming up, you can pick the trading strategy that makes the most sense. For a bullish stock that is moving higher, you would want to buy calls or sell puts. Both are bullish strategies, and you would make money the higher the stock price goes. For a bearish stock that you expect to move downward, you would want to buy puts or sell calls. These are your bearish strategies, and you would make money as the stock price moves lower. For a neutral stock that you don't expect to go up or down, just stay where it is, you could sell puts or sell calls. You wouldn't want to buy an option contract in that kind of market because they wouldn't make you any money and selling would be better. And remember, when you are setting up and entering your bullish, bearish, or neutral trades, good risk management means only allowing a max 3% loss of your total account size. So if you want to buy a call option and you have $5,000 in your account, make sure your call does not cost more than $150. That's how you protect yourself from blowing up your account in one trade. Okay, so now we need to figure out when the market or stock is bullish, bearish, or neutral so we can actually take on and use one of our strategies. So the fourth key point is being able to read a stock chart. This is known as technical analysis. To put it simply, up to the right on a chart is bullish, down to the right is bearish. Here are some other helpful tips to spot these trends as well. This is the most important one for beginner traders to understand. Generally, if the stock price is moving up to the right and trading above the 50-day moving average, and the 50-day moving average is above the 200-day moving average, this is considered bullish. If the stock price is moving down to the right and trading below the 50 and 200-day moving averages, and the 50-day moving average is below the 200-day moving average, this is considered bearish. If you see three big fat green candles going up in a row, this is a bullish signal and often suggests a bullish trend is in place. On the flip side, if you see three big fat red candles going down, this is a bearish signal. I also love to use what's known as an ABCD pattern, both on bullish and bearish trades. If you see a stock price moving up higher, then dropping a bit, but not all the way back down to where it started, then moving higher again, you could be looking at a bullish ABCD pattern. If a stock moves lower, then bounces back up for a bit, but starts to fade again after a few days, that's likely a bearish ABCD pattern. So as a beginner, when you see a chart, you need to look at it and look at the information and determine if you think it's bullish or bearish. If you're not sure, don't make a trade. Never hope or try and create something on the chart that just isn't there. It's either leaning one way or the other, and it's usually in plain sight. If it's not, try looking at a different stock chart until it hits you in the face with how obvious the trend is and which strategy you should be using. Another key thing to understand whether you're trading bullish or bearish is option contracts don't last forever. They all have what's known as an expiration date. The expiration date for a contract could be 1 day away, 7 days, 30, 90, 365. The key for newer traders is understand that the expiration date you pick for your trade really matters. If you are buying calls or puts, the shorter the expiration date, the faster you will need the stock price to rise or fall. If you buy a call option that expires 5 days from now and the stock you bought the option on stayed at the same price, you will lose money. You would need the stock price to start moving higher almost immediately in that scenario. But if you bought a call option on the same stock with a 90-day expiration date, you would have given yourself more time for the stock price to move higher. If it doesn't in the first week or two, it won't be that big of a deal. When selling options, the further you go out in time for your expiration date, the more, in most cases, you're going to get paid. But if you go too far out, you may be wasting an opportunity by being in the contract for too long. The sweet spot, at least for me, when selling calls and puts is around the 30 to 45 day mark for an expiration date. This gets you paid a good amount for selling the contract, and you aren't locked into that trade for an overly long time in case the market shifts. When you put everything together, you get the confidence of knowing your risk is being managed. You're not going to blow up your trading account with one trade. You know how options, both calls and puts, work, removing the confusion, making trading easier. You don't have to waste time going back and forth on strategy because you know how a bullish and a bearish setup works and whether to use a call or a put. You understand how a stock chart works and what it needs to look like to support your strategy. And you don't have to second guess what your expiration date should be. You have windows of time to look at right away to make your trading faster. If you want to build on what you learned in this video and follow a step-by-step system to trade with more confidence in just 7 days, check out that link for the Options Academy course in the description. And if you want a super simple way to win more trades right away, watch this.